Today we're going to be taking a look at the Brookfield Real Assets Income Fund, ticker RA. This was a request over on our Discord channel not too long ago, and there are some really attractive things about this investment that I want to go over. RA currently offers a dividend yield of around 14%, and this does pay monthly dividends. So right away, just on those things, this sounds like this could be a good pick for someone looking for monthly income, or someone looking to reinvest those dividends to create a nice snowball effect. But let's take a deeper look and see what this fund holds and try to figure out if this might be a good investment worth considering for some people. The Brookfield Real Assets Income Fund is a closed-ended fixed income fund launched and managed by Brookfield Investment Management. The fund primarily invests in securities and other instruments of companies, which include real estate securities, infrastructure securities, and natural resource securities. According to Brookfield, the goal for this fund is to provide a high level of total return, primarily through high current income and secondly through growth of capital. This fund was launched back in December of 2016, and today this fund has over $860 million worth of total assets inside of it. Looking at this fund's dividend history, we can see since being launched, this fund has never cut its dividend. Right now it currently pays 19.9 cents per share per month in dividends. This gives it a current dividend yield of about 14%, which is exceptionally good. This means if you invested about $10,000 into RA right now at its current share price of $17.07 per share, you'd be earning roughly $116.41 every single month. That's probably enough to cover a couple of your bills, and it's significantly more than if you were to invest that same amount of money into a stock like Coca-Cola or say Procter & Gamble. RA is a closed-end fund, or a CEF, which is a type of investment that's similar to an ETF in your more traditional mutual fund inside of your 401k. They're all diversified investment products that hold a collection of different types of investments, but what sets CEFs apart in particular is that they use leverage in order to boost their overall returns. They're also actively managed, meaning that you have people who hand select everything that goes into each fund. This results in CEFs charging much higher expense ratios on average than the other two types of investments. There's also a fixed amount of shares of a closed-end fund, whereas ETFs and mutual funds can change their shares depending on the demand for the investment. I'm going to talk about the things that I like about this holding and some of the things that I'm not a fan of, starting with the things that I do like. For starters, I like the company that issued this fund, which is Brookfield. They're a large Canadian alternative asset management company, and they have a long history of managing their investments pretty well. They're one of the largest investment companies in North America and really the whole world, and they're definitely experts when it comes to investments. When I first came across this fund, I really liked what I read about it, which is that it invests in infrastructure and natural resource securities. For people interested in high income, we're often very limited to just a handful of sectors. It's very easy for investors like us to load up very heavily on two sectors in particular, which are real estate and business development companies, which can result in us not being well diversified. But seeing how RA holds infrastructure and natural resource investments, holding this fund can help income investors diversify their portfolios across even more sectors. I was particularly interested in their natural resource investments, but unfortunately it looks like they only make up about 8.3% of this fund's total assets. One nice feature that's rare is that their dividend reinvestment plan sometimes offers a discount. According to this fund's annual report on page 82, it says that if the share price of RA is currently trading at a premium to its NAV, then shareholders who decide to reinvest their dividends will receive a 5% discount. But during months when the share price is below the NAV, otherwise known as selling at a discount, then there is no discount for reinvesting your dividends. I'm not aware of too many stocks that still offer dividend reinvestment discounts, but they do exist. I don't know if they still offer this or not, so you'll have to confirm this for yourself if you're interested, but I do know at one point Prospect Capital was one stock that did offer a DRIP discount, but I don't know if this is still going on or not. Finally, another really good thing about this fund is their solid dividend performance. Since being launched in December of 2016, RA has never reduced their monthly dividend amount of 19.9 cents every single month up to this point. So given all this, there are some good things going for this CEF, but I also want to touch on some things that I'm not a big fan of about this holding. Starting with the expense ratio for RA. Naturally, closed-end funds have much higher expense ratios on average, given how they're not usually passively managed. When you have a fund manager hand-selecting and sometimes making trades within the fund on a regular basis, that does come at a higher cost. So it's not unusual to see a CEF with an expense ratio of around 1 to 2% or higher. For RA, according to CEF Connect, it currently charges a 2.76% expense ratio. That's slightly higher than average, I'd say, for a closed-end fund, but it's not terribly higher. While many people oppose investing in anything with a high expense ratio, I'm of the opinion that it can be justified sometimes. An example would be if a fund's been able to provide a long history of solid dividend returns, which RA has done up to this point. But it ultimately depends on your own personal preference when it comes to higher fees. I personally do hold some closed-end funds with expense ratios exceeding 2%. One of my biggest concerns about RA is the erosion of this fund's NAV, although the issue was made worse by the bear market that we're in. The net asset value is basically the total value of all the assets that the fund holds. And this is kind of a tricky thing to talk about with closed-end funds, because typically it's not ideal to see a fund's NAV drop dramatically in a short amount of time, but a gradual decline of a CEF's NAV isn't always a bad thing either. I'll show an example of what I'm talking about. Let's take a look at PCM, which is a closed-end fund that's been around since 1994. Originally launching with a NAV of $14 per share, today their NAV is all the way down to $6.80 per share. Over the course of about 30 years, this fund has lost about half of its net asset value. Yet despite this, when we compare PCM with the S&P 500 with reinvested dividends, PCM has actually beat the index over the last 25.71 years. With RA though, we can see since being launched, its NAV has dropped by almost 39%. But RA's only been around for about 6 years compared to PCM's 30 years. So maybe you can see the concern I have here with just how much this fund has lost its value. This year, RA's share price and net asset value have been increasing, although at a much slower rate than the overall market. Another concern I have for this fund are interest rates. Unlike some holdings like BDCs that have actually benefited from rising interest rates, I don't expect RA to experience the same benefits. Because this fund holds mostly real estate and infrastructure assets, these are companies that rely heavily on lower interest rates in order to grow. Developing properties and new infrastructure requires a massive amount of money to borrow. Since rates are still high, it's going to slow down growth in these sectors. This can also have an impact on equity REITs' ability to expand during these same conditions. Higher interest rates also have a negative impact on leverage, something that closed-end funds use a lot of. But to summarize our look at this fund, I think it's a decent holding. I am concerned about how well it's going to perform in the upcoming months until interest rates go back down. If rates still remain high for a long period of time, then RA is probably going to keep struggling for a while. I believe the person who requested this said they bought a whole bunch of shares of this while it was trading at a really steep discount, and I think that's the best way to invest in this fund. The high yield and the exposure to different sectors that income investors don't usually get are the best parts about RA in my opinion. I don't personally hold this fund, and I really don't have any interest in holding it right now either. I'd advise anyone who holds this or is thinking about holding it to not dedicate too large of a percentage of their overall portfolio to it. I personally would still recommend investing in a wide range of different BDCs, REITs, and not to mention at least one good dividend growth ETF. But overall, I think it's a decent pick. I do hope that net asset value will recover a lot more and that interest rates will start going down, but I have no idea when that's going to be. With that being said, thank you all so much for watching today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.